The next area of business law that I want to discuss with you in the area of business organizations is partnerships. A partnership is a relationship created by the voluntary association of two or more persons to carry on as co-owners a business for profit. It's distinguished from co-ownership through the operation of a business requirement. The relationships between the partner and the partnership and the principal and agent both contain fiduciary duties, meaning that partners owe the highest duty of care to their partners and the partnership. Here's an example. Ford and Mitchum were partners engaged in construction. Ford was killed at work. His widow made a claim for workers' compensation against the partnership, but Mitchum opposed this on the claim that Ford was a partner and not an employee, meaning if you're not an employee, you don't qualify for workers' comp. The question was, could the wife recover workers' compensation death benefits? The answer was, the fact that a partner works doesn't make the partner an employee. The employment relationship involves the right of the employer to control the employee. A partner must act in a proper manner, but a partner is not subject to the control of the partnership like an employee, and therefore is not an employee of the partnership. So in this case, wasn't an employee, no workers' compensation. The characteristics of a partnership are as follows. Again, it's a voluntary agreement where partners contribute capital, services, or both. They are co-owners, and they have the business for profit. If no profit is intended, then it's considered an unincorporated association. In a general partnership, the parties contribute both capital, services, either capital, services, or both. The characteristics of a partnership, these include shared control in the running of the business and the fact that the parties share profits and losses. So often the cases involve whether a partnership exists or not, like the Mitchum case that we just talked about. And these two factors are what the courts look at. The sharing of gross returns as opposed to profits is very slight evidence of partnership. In the Chaikin matter, this involved a barbershop partnership, or whether it was a partnership, and I abbreviate PS as partnership. The court looked at several factors. Was there a partnership agreement? This agreement did not conclusively establish a partnership. Chaikin made all decisions for the partnership. Chaikin provided a chair and shop. Others gave labor only. At dissolution, nothing was indicated that partnership's assets would pay off partnership debts. And they also had no profit sharing. They shared income, but not profit. For income and tax purposes, the partnership is simply an aggregate of the partners, and the income and losses simply flow through to the partners. What this means is that the partner gets a draw check, and that's directly taxed on your 1040. And they receive their, instead of a W-2, a partner gets a K-1. So the partnership itself files a 1065 form, and each partner gets a K-1. But the income reflected on that K-1 is basically the profit that the partnership made. There's no double tax on the partnership income and then the partner income. The losses just flow through to the partners. A partner's rights are determined by the agreement, or if they have not provided for such in their agreement, by the Uniform Partnership Act. The partnership agreement governs the partnership during its existence and may also contain provisions relating to its dissolution. The partnership agreement will generally be in writing, and this may be required by the statute of frauds. In the early 1900s, this is an example of a real case, the New Kids on the Block grossed $74 million in 1 year. Their promoter, Mr. Starr, obtained $60,000 from a man connected with organized crime and $50,000 from another businessman to finance the initial recording and promotion of the New Kids. All three agreed with a handshake that 50% of the profits from the group would be shared between the two financiers and that the promoter would receive 50%. Later, Starr denied that a partnership existed on the basis that such an agreement would have had to have been in writing. After he tried to buy the silence of certain witnesses, however, the jury decided that an oral partnership agreement existed. Let's talk a little bit about partnership agreements. The creation of a partnership may be by agreement or implication. Again, an agreement should carefully spell out all terms and rights of the parties. Here is a form of partnership agreement. I apologize, it's almost impossible to read this, but it is a sample partnership agreement that contains a number of provisions that you might see in a typical partnership agreement. Now, a partnership with no agreement. This is where the court has to decide if, in fact, there is a partnership when no agreement exists. So the court looks at, number one, control. This is very significant in determining whether a person is a partner. The more control they have over the business, the more likely they may be considered a partner. Sharing of profits and losses is also strong evidence of partnership. If you think about in your own job, if you're not a partner, you typically get paid a salary, whereas the owners of the business get profit and share losses. So this is pretty strong evidence. Sharing profits is prima facie evidence of a partnership, but gross returns is only slight evidence. Co-ownership is also not evidence of partnership by itself. And the contribution of property could be a factor, but the lack of contribution does not mean an individual is not a partner. And a fixed payment oftentimes may not be considered as a factor with regard to whether a partnership exists. How do you create a partnership? Well, it can be created by an individual's conduct and its appearance to third parties. This would be by implication. A partnership can be created for any lawful purpose. Now let's talk about firm name. In the absence of a statutory requirement, a partnership does not need a firm name. Now in my firm, our name was Kroloff, Belcher, Smart, et al., which means and others. A firm name cannot be deceptively similar to another. And fictitious name statutes require registration of the name to protect it. Again, let's talk a little bit more about partnership existence. Several factors can influence the determination of whether a partnership exists. But again, the sharing of profits, it creates a prima facie presumption that a partnership exists. Courts also look to the tax return, and as I mentioned previously, if someone receives a K-1 at tax time instead of a W-2, that would be a factor a court could look at to determine whether a partnership exists. Here's a quick example of partnership existence. The fact that one doctor received half of the net income did not establish that doctor as the partner of another doctor when the former was guaranteed a minimum annual amount. In that case, the doctor had income tax and Social Security deducted from payments, and that indicated to the court an employer-employee relationship. Another example is Pettis versus Yukon. You can kind of read the facts for yourselves here, but basically Yukon bought a business and hired Pettis. Pettis testified that they agreed they would be partners, with Pettis managing the two stores and earning the same amount he had earned at a previous employer. He worked 70 hours a week, and he stated that his capital contribution was sweat equity. He also testified that on many occasions Dr. Yukon told him and others that they were partners. In 1992, Pettis asked for an accounting because he obviously wanted to get more money. And the next month, Yukon fired Pettis. Pettis sued for the breach of an oral partnership agreement and an accounting. Can a partnership be formed when a person only contributes expertise and labor instead of capital to the partnership? The answer is yes. In a partnership, that's an association of two or more persons to carry on as owners of a business for profit. The, again, sharing of gross returns does not by itself establish a partnership, but the receipt by a person of a share of the profits is evidence. Also, Yukon held Pettis out as his partner to the public, and the trial court found that Dr. Yukon strung Pettis along. That was given great weight on appeal. When questioned about the existence of the partnership as the relationship deteriorated, Dr. Yukon never denied the existence of the partnership. He just said that without a written agreement, Pettis couldn't prove it. And again, you can have an oral partnership agreement. Now, as to third parties, a partnership liability can be established by estoppel. This is where a third person is led to believe persons are partners, and partners would then be estopped to deny that a partnership exists. Shavers is an example where CWC was a welding business. The sons joined their father in the business, claiming they are employees of the dad. EBSCO provided services for CWC and extended credit, relying on the fact that CWC was a partnership. This meant the sons were estopped from denying liability as partners when debts weren't paid by CWC. So the importance here is if they were employees, they wouldn't have to pay any debt, but as partners, they would. Here's another partnership estoppel example. In this case, Mrs. Collins allowed the partnership to use her name to help get it started. A registration certificate was filed with the city, signed by the partners and Collins as partners. If a creditor relies on this registration statement in extending credit to the firm, Collins will be estopped, that means stopped, if you look at the root word there, from denying that she's a partner. Now, who can be partners? Well, any person competent to enter into a contract. And some of you may not have had the 18A class, but a person that would not be competent would be, for example, a minor. Partnership property. There's an equal right to use firm property for partnership business. Partners have no interest in specific items unless they own it. And a charging order is an order where a creditor proceeds against a partner's individual interest, not partnership property. A partnership property vests in the surviving partners, so if a partner dies, like joint tenancy with right of survivorship. I've abbreviated that there, and we'll talk more about joint tenancy when we get to property. But it basically means that if you hold a piece of property as a joint tenant, when one of the joint tenants dies, the remaining joint tenants automatically take ownership of that piece of property. So let's say there are two partners and one dies. The partner that dies wants to leave his or her partnership asset to their spouse. If that asset is held in joint tenancy, the fact that they try to leave it to their spouse is not relevant because it automatically passes to the surviving partner. Often, as a business operates, the partners bring some of their own items for use, and we did that in our firm. For example, furniture or your own car. And these items are then extensively used by the partnership, and people forget whether they were given to the partnership or intended to remain personal assets. And this can be a particular problem when assets are changed or added to in the form or character at the expense of the partnership. So let's say I bring my own car and the partnership performs repairs on it. So it's really important that the partners have some form of written statement signed at the time the partner brings a personal asset so that they know how to deal with it for use in the operation of the business. An assignment. This is acceptable. You can assign your partnership interest if it doesn't violate the partnership agreement. An assignee is not a partner without the consent of the other partners. Now, what's the authority of partners? Well, the scope of authority is determined by the partnership agreement. Majority of partners prevails. Individual partners may have express authority under an agency theory. This might mean implied powers as co-owner of business, and the partnership may be bound by act of partner with third party if the third party did not know of limitations on their authority. Authority of majority partners. They have ordinary business functions, not binding on the other partners if it violates the partnership agreement, and third parties are not bound by restrictions in the partnership agreement unless they know of these restrictions. The express authority of individual partners, they are agents of the partnership, and you look at their agreement. Customary authority includes the authority to make contracts, sales, purchases, and take out loans. Limitations on authority must be provided in the partnership agreement, but third parties should check the partnership authority when dealing with a partner, and secret limitations among partners are very seldom binding on outsiders. These are certain prohibited transactions. A partner cannot undertake these without express approval of the partnership: ceasing the business, being a surety, arbitrating or agreeing to arbitration of disputes, admitting a judgment, assigning partnership property, or personal obligations. Here's an example. In Summers and Dooley, they formed a partnership to collect trash. Summers became unable to work, and he hired a third person to do his work and paid him out of his personal funds. Summers suggested to Dooley that the third man be paid from partnership funds, but Dooley refused. Finally, Summers sued Dooley for reimbursement for the money he had spent. Did Summers have the authority to employ a third man? The answer that court came up with was no. Summers had no authority to employ the third man at the expense of the firm. Because the partners were evenly divided on the question of such employment, Summers had no authority to act. Now I want to talk to you about duties of partners. And these include the following duties, and we'll go through each of these: loyalty and good faith, obedience, due care, and to provide information. In the Gilroy case, a partner stole another partner's business, took partnership contracts, withdrew partnership funds for personal use, and the trial court awarded damages, including punitive damages. The Court of Appeal said that the damages were for breach of the fiduciary duty, and these were appropriate, but not the punitive damages. So let's talk about the partnership duty of loyalty. This is an example again. A partner renewed a building lease occupied by his firm in his name alone. That partner was forced to hold the lease for the firm. The failure to renew the lease in the name of the firm was a breach of the duties of good faith and loyalty owed to the firm. Partnerships, again, have a duty of obedience. Here's an example. A partnership agreement required that each partner in an insurance sales firm give his, quote, entire time, end quote, to the business and not engage in any other business that would work to the disadvantage of the partnership. One of the partners engaged in an insurance-related business outside the firm, and this was considered a breach of that agreement. A clause requiring full-time and exclusive services could also be construed, for example, to prohibit a partner in a pizza restaurant from doing early morning custodial work at the local college. Now, in my partnership agreement, we also had this type of clause. So I've been teaching at Delta College for a long time, prior to even becoming a partner and for the 9 years that I was a partner. And so I asked this question of myself. Was I allowed to teach at Delta College while being a partner at my old firm? Would it violate that agreement? Think about it for a minute. And as you do that, let me explain why I found that it was appropriate, and I have had approval from the partnership to teach. But even without approval, part of your duties as a partner, particularly in a law firm or really in any business, is to bring in new clients and market your firm and provide community outreach so that people who might need a lawyer at some point later have gotten to know who you are. So my teaching at Delta College in some instances led to direct clients, and in other instances referrals from former students or teachers at the college. So being a teacher at Delta College did not violate my partnership agreement. In fact, it was within the spirit of the agreement to help market our business. Again, I indicated partners owe a duty of information, and this means a partner who receives information relating to the partnership has to pass this information on to the other partners, particularly when any special or legal notices are received. Partners have certain rights. They have the right to manage, an equal right. They can inspect the books, share profits by agreement, and they're entitled to compensation. Now, every partner can handle this in a different way. In my firm, we had a managing partner, but we each had an equal right to manage, but we would have to go through that managing partner, and we would vote on important issues, majority rule. We all had the right to inspect books, and our share of profits was different. Each partner got a different amount of compensation depending on the prior year's performance, years of service, and other community outreach and activities that the firm found were important to maintaining our business. So each year we voted on compensation. And again, the share of profits was different for each partner, and that's perfectly acceptable. Continuing with the rights of partners, they do have the right to repayment of loans, payment of interest, but not on capital or account balances, contribution and indemnity. So what that means is if partners pay more than their share of a debt or a liability, they're entitled to indemnity or contribution from the other partners. They're also entitled to a distribution of capital, which is a return of capital contributions unless otherwise agreed. With regard to loans, I want you to note that the person contributing the funds must get a written statement signed by the rest of the partners as to whether it's a capital contribution to the partnership or a loan. The importance of this is that capital contributions generally don't bear interest, whereas a loan would. Now, liability of partners. On partnership contracts, partners are jointly liable. This means that they're all liable on a contract. With torts, they're jointly and severally liable for torts committed within the scope of the business. This means that a partner could end up paying the entire amount of a judgment, even if they're not the partner who committed the tort. Now, a partner who has paid does have the right to contribution from other partners, but let's say that there's only one partner who still has money and the other partners are bankrupt, and one of those partners happened to be the one who committed the tort. The solvent partner may have to pay the entire judgment and have nothing to get back. Now, liability of new partners I want to talk about for a minute. It is limited as to existing debts. It's unlimited as to new debts. A new partner also typically has to buy into the partnership because the new partner is acquiring a piece of the existing partner's interests for which the existing partners will want compensation. Now, in my old firm, there were two levels of partners: junior partners, which did not have to buy in, but we provided basically sweat equity, and then senior partners who did have to buy in at that point, and you had to be voted unanimously to move into the partnership and then to move up in the partnership. The difference is once you became a senior partner, then you did get to vote on compensation, and it was for that additional benefit and an increased percentage of compensation that they require to buy in. New partners are subject to clauses in the partnership agreement that deal with the amount of time the partner has to spend with the partnership. And again, a clause requiring full-time and exclusive service could be construed to keep that partner from working in the pizza restaurant, as we already discussed. A partnership can be dissolved by the parties themselves in accordance with the terms of the partnership agreement, by expulsion of a partner, by withdrawal of a partner, or by the bankruptcy of the firm or one of its partners. A court can also order dissolution of a partnership when, because of insanity, incapacity, or major misconduct of one of the partners, the partnership needs to dissolve. Dissolution can also be decreed because of a lack of success, impracticability, or other circumstances that equitably call for dissolution. Dissolution, when it happens, ends the right of the partnership to exist as a going concern. Notice of dissolution, except dissolution by operation of law, must be given. What happens once a partnership dissolves? Well, it goes through a winding up period. And this means the assets are distributed and the partner's authority is reduced. How are the assets distributed? First, outside creditors. Second, loans of partners to the partnership get paid. Third is capital account balances. And fourth is you split whatever's left between the partners in the percentage that's provided for in the agreement. Now, continuation of a partnership business. This can be provided for in the agreement, but what happens, for example, if a new partner is brought on? Well, actually, a new partnership is formed and a new agreement is signed, and that's what happened when I became a partner.